Hi everyone, trust you're all doing fine. I thought of doing this small video on the financial services sector wherein I've tried to present a comprehensive picture of the sector itself and further break it down into segments and subsegments and understand as to what kind of roles does each of these segments entail. So who is it for? It could be beneficial for MBA aspirants, CAs, aspiring CFAs, undergrad, postgrad students, for that matter, anyone who wants to understand this sector a bit better. So let's get started. I'll take you to my first and the only slide of this presentation, which is here. So what I've tried doing here is I have divided the whole BFSI landscape, as we call it, banking, financial services, and insurance, into three broad categories, namely banking and finance, investment management, and investment advisory. I've clubbed in the ancillary part also with investment advisory, which I'll explain later. So one thing is that this whole ecosystem is extremely fluid, dynamic, and evolving, and therefore there would be a lot of cross linkages between these categories themselves, which I'll try to explain through my video. But at an overall main functionality perspective, I think these three broad categories make complete sense. One more thing before I proceed is the whole idea behind making this video was to help you understand how each of these subsegments are different from each other so that when you're planning your career trajectory, if you want to be a financial services professional, you should know where you exactly want to fit in or go. I'll be doing this video in three different parts, and each part I'll take up one particular category along with the key roles entailed in that category. So let's get started with our first category, which is banking and finance. What I've classified under this category are the institutions which are primarily involved in the business of borrowing, lending, managing cash, credit, or other financial transactions. So I've enlisted some institutions here, like banks, NBFCs, housing finance companies, microfinance, fintech, P2P. In very simplistic terms, all these organizations or institutions are involved in this process, which is borrowing. They borrow and they lend. And in between, they earn an interest differential, which is known as spread or the margin. Now, borrowing is at the cost of borrowing, and it can be from various sources, such as demand deposits. Demand deposits is nothing but public deposits, your and my money in the form of CASA, current account, savings account, or term deposits, FDs. Or it can come from, in case of banks, RBI, other banks, financial institutions, or from the debt capital markets. Now, on the lending side, the lending could be to the wholesale sector or to the retail sector. Now, wholesale, when I say, I mean large corporates, big businesses, mid corporates, etc. And this would be in the form of either project finance, term loans, or working capital loans. These will be mostly secured, which is backed by a collateral. On the retail side, you will have consumer loans, individual loans like personal finance, you'll have small businesses loan, the whole MSME gamut will fit in somewhere here. It could be at the cusp of wholesale and retail, but primarily retail. Retail, you will find again unsecured and secured both. Some examples of the unsecured lending could be personal loans or small business loans, which are unsecured in nature. And the secured loans are, of course, it could be vehicle finance, it could be equipment finance, mortgage loans, and so on and so forth. So this is on the lending side, and the rate at which a bank lends is called the yield. Now, apart from this, of course, the banks or these institutions could be involved in some sort of investments. There could be some non-fund based activities like giving letter of credit, bank guarantees, etc. So, of course, there will be a lot of other ancillary and peripheral activities that these institutions would be involved in. But from the main functionality perspective, this is what they do. Coming on to now the list of institutions that I've enlisted here. First is banks. And of course, these are extremely pivotal to the entire ecosystem. There are various types of banks, and if you want to understand what all types are there and what all roles do they play, you can visit the RBI website wherein you'll find a lot of information about the banking sector overall. I've enlisted a few types here, namely commercial, cooperative, the new age small finance banks, and rural banks. There are 34 commercial banks in India, and of which 12 are publicly owned and rest are privately owned. Coming on to NBFCs, now non-banking finance companies are also very important. While they are very similar to banks in terms of their primary activities, which is lending and investing, there is a whole lot of difference between banks and NBFCs. And while in this video, I won't be able to take you through all the differences and nuances. The major differences are in the regulatory framework, such as the capital adequacy norms, the asset classification norms, etc. And also one big difference is in access to funds. So access to, while banks have access to demand deposits, which is public deposits such as CASA and FDs, as well as RBI funds. NBFCs do not enjoy that kind of access to funds, which of course gives banks a big competitive advantage in terms of cost over NBFCs, because CA and SA, as we know, are very low cost deposits, and which in turn also helps banks to lend at a much competitive rates as compared to NBFCs. Next is housing finance companies, which can be called as a niche NBFC, which caters to mortgage financing. It could be in the premium housing sector or affordable housing finance. HFCs also have products like loan against property and lease rental discounting, etc. Next is microfinance institutions. As the name suggests, these are into micro lending, and the ticket sizes for these loans could be as low as 20,000, 25,000. The concept of microfinance started with group lending called SHG, self-help groups, and thereafter JLGs, the joint lending groups, wherein loans were given to a small group of people with individuals which had similar kind of business interests. So these are very, very small entrepreneurs, primarily women entrepreneurs, say who are engaged in tiffin services, salon services, or some kind of vegetable vending, milk vending, handicraft, etc. And these individuals back each other's loans or guarantee each other's loans. So while the model itself has evolved a lot over the years and the industry has gone through its own ups and downs, I personally feel there's a huge scope of this industry to grow further in India. Next is fintech. Of course, our very famous fintech platforms. Every now and then we keep reading in the newspapers that new and new startups are coming into this space. Fintech platforms, especially the lending platforms, although fintechs can be, of course, present under this category and other categories as well, it's more of a horizontal. But the lending platforms primarily started as pure play technology platforms and started providing the services to more conventional type of NBFCs and banks, such as digital onboarding, mobile banking, credit underwriting using algorithms, which also not just gave a better credit underwriting ability to these institutions, but also reduced their turnaround times. While a lot of people feel that fintech could be a challenge or a threat to the conventional NBFCs or banks, I feel that these rather work in tandem and more synergistically with the conventional types, because a lot of fintechs have been absorbed by these bigger companies, or there are a lot of services that are being availed from these fintechs by these companies. There are also fintech platforms which act as aggregators and also have a risk sharing model with other NBFCs and banks and help them get access to more and more consumers or borrowers. They are also helping in new age psychometric analysis, social media mapping, and footprinting of consumers, which help better the asset quality and the outreach, of course, of these players. The space is evolving, and let's see how it pans out going forward. P2P, again, peer-to-peer lending is, we can call it a subset of the fintech platforms. And earlier, this also started as a pure play technology platform, but now it's a type of NBFC and it's regulated by RBI. So all these institutions mentioned here are regulated by RBI. So housing finance companies are regulated by National Housing Bank, NHB, which is now also merged with RBI. So coming back to P2P, peer-to-peer lending is you can lend to me, I can lend to you. The space is evolving. I would say it's still the regulation around it as well as the platform itself is at a very nascent stage in India as compared to other countries. But again, a huge potential, especially when it opens its doors to small businesses lending and entrepreneur lending, because then people who need funds for growing their businesses can have access to cheaper and quicker funds. So let's see how the space pans out, but another very interesting space, and please do. So another very interesting concept here is that of crowdsourcing and crowdfunding, which I've not mentioned in here because it's not very prevalent in India, and also the regulatory framework around it is not very evolved. These platforms are much evolved in the UK and the US. So what they do is like a technology-enabled platform. They'll pull in monies from retail investors like you and me, and some institutional investors as well, and they will do the credit underwriting here, and they will lend to various borrowers who could be either individuals who need money for some businesses or small businesses, MSMEs, real estate developers who need the last mile funding, or anyone who is in need of an alternative finance. So these will be generally short term loans. Rate of interest could be from medium to high. So interesting concept, is very similar to P2P, but in P2P there's more transparency as to who is to lending to whom. Where in crowdsourcing and crowd lending platforms there is pooling of funds. So this brings us to the end of our first segment, which is banking and finance. And now let us have a look at the key roles these organizations offer. So the key roles could be broadly categorized into, say, asset side roles, liability management roles, treasury, digitization technology, and then there are other roles such as operations, finance, compliance, etc. There could be marketing strategy also. So these roles are very common with other organizations as well, and that's why I'm not going to explain these or focus on these. Let me try to explain the specific roles to these institutions. So coming to the asset side roles, which is the lending roles, which are very key to these organization institutions. There could be corporate lending, which is more wholesale in nature, which could be to large corporates, mid corporates, other institutions, project finance, infrastructure finance, etc. And there could be commercial loans, there could be MSME, which is micro, small, medium enterprises. And then there could be more retail flavored loans, like more granular loans, like consumer lending, education loans, two-wheeler loans. Then there is unsecured lending, which is in the form of personal finance, credit cards, and then also debt syndication. These are only representative list. There could be multiple other types of sub departments which are managing different kind of loans. Debt syndication comes more in the wholesale part because it's where multiple institutions come together as a consortium to lend to one borrower. Now, what happens on the asset side or the lending side is, of course, the product team first makes a product. Now, the product, what is the product? So like, for example, personal loan is a product, but now there could be variants of that personal loan as so as to suit its borrowers' demands. The sales team, which onboards a customer or sells this product, also gives feedback to the product teams as to what is required from the borrower and what the demand is. Now the sales team generates leads and brings on and onboards the borrower. Then this passes the information about the borrower, detailed information is passed on to the credit team. Now the credit team does a detailed credit underwriting of the loan and the borrower by detailed analysis of the data which has been provided by the borrower. They will check other parameters such as the credit score, the CIBIL or other which comes from the bureaus, scores of these borrowers and other parameters as well. So there could be a scorecard based credit underwriting. Nowadays there are algorithm based credit underwriting as well. When the underwriting is done, then a CAM is prepared, which is the credit appraisal memorandum, which has all the details about the borrower and the loan. Now this CAM goes to the risk team. Risk team is responsible for doing its own evaluation on the borrower and checking if there are any pain points which may lead to some kind of delinquency. There could be certain deviations from the policy which has to be flagged off by the risk team. Now, once the risk team passes or approves the CAM, then only the final disbursement is made. So this is a typical cycle on the lending side. Now, also there is a difference between the wholesale lending and retail lending, because on the wholesale lending there is a concept of a relationship manager. So these relationship managers are responsible for bringing for the sales part as well as for the credit underwriting part. Maintain a relationship with the large corporates, understand their borrowing needs. If there is a project, they will do, say, understand the business model or the cash projections of that project. And then after understanding the borrowing needs, they will also do a credit appraisal of the particular borrower or the loan, and also prepare CAM and then send it to the risk team. While in retail, it's a separate function generally, sales and then credit is separate because these deal with volume. So sales team is also called feet on street at times. Okay. Now risk and policy I've already touched upon. Next is liabilities management and debt raising. So as I mentioned at the beginning of my video, there could be various ways in which an institution borrows. It could be CASA, it could be FDs, and it could be debt raising from RBI, other banks, financial institutions, or from the debt capital markets. So this liabilities management team does all of that. They'll also have a product team as well as, say, a sales team, which will, so products could be different types of FDs depending on what is the demand from the end consumer. There's also a lot of cross sell between the asset and the liability side. Then comes the treasury management. So treasury is a very central function to any financial institution because they act as a bridge between the liabilities and the asset side. They work in very close proximity with the liabilities team and also with the assets team. So what they do, their major function is doing the asset liability management, which is very, very critical to the health of any financial institution. So two functions are responsible primarily for maintaining the health, the risk and the treasury. Risk takes care of the asset quality and treasury takes care of the ALM, asset liability, management. So any kind of asset liability mismanagement may lead to in fact, if you would have read about the turmoil in 2, 3 of the big NBFCs, it has happened primarily on account of the ALM mismatches. So, of course, there were certain other systemic reasons as well, but ALM is extremely important. Now, what ALM is, I'll again briefly explain. So, say if you have the borrowing for say a tenor of 2 years, but you are lending for say a tenor of 5 years, then there's a mismatch. There's an inherent mismatch. So now you borrow from various sources, and these sources will have different kind of rate of interest and tenors, and you're lending to various sources. So there is a balance which is to be maintained, and on a daily basis, the cash flows of the institution are to be checked. So that's what Treasury does. Treasury also does investments and market risk analysis and investor relations are some of the other things they do. Next is digitization and technology. Now, digitization and technology is more of a horizontal than a vertical because it runs through the functions and through the organization and all functions. But a lot of organizations nowadays have a separate dedicated team which is responsible not only for internal digitization of say operations, but also a lot of innovation, keeping up with the competition because it's an evolving space. A lot of alliances with other fintechs, and they're always on the lookout of what technological advancements are going on in the industry. So again, a very interesting role, and if you have an knack for technology, then and finance, I think this is a good place for you to be. Then comes, I'm not going to touch upon operations, finance, and compliance because, or marketing strategy for that matter, because these are common with any other organization, except for compliance because it's a highly regulated business. So compliance becomes a very important function for a bank. So that's all for this part, and hope you enjoyed and found this video informative. I'll soon be coming up with the part 2 and part 3 of this series, wherein I'll cover investment management, my personal favorite, and investment advisory and ancillary respectively. If you have any queries so far, please feel free to put it in the comment box below and I'll try to answer. Also, if you want any particular topic to be covered in a video, then let me know and I'll try to make it for you. And now the ritual. Please like my video and subscribe to my channel Curated Milieu. Until then, stay safe, keep learning, keep growing. Thank you so much for watching and bye bye. Take care.